Getting the money to buy real estate is super important, and nobody really buys real estate unless they got the money, right? So this is what is hard money in real estate. A lot of people don't know what hard money is, what it means. So join me and let's see how you can use hard money to buy real estate and make money. In this video, we're going to define hard money and where that term comes from. We're going to talk about sources of hard money and how to get it. And we're going to show you how I've used hard money to buy lots of properties that probably were not lendable by a typical institution, but once fixed, I could sell for tens to sometimes hundreds of thousands more than I paid by using hard money. So let's dive right in. The term hard money simply means a loan backed by hard assets like real estate. Real estate is a hard asset, right? Versus say a stock or a bond. So these are loans that are made on assets like homes, apartment buildings, commercial buildings, or other types of hard assets. Another term often referred to is asset-based loans or bridge loans. Typically, people who get hard money loans are not keeping them for a long time. When I use hard money, I'm typically buying a property that I'm going to renovate or fix up or do repairs on, and there'll be a current value and an after repaired value. The lender will look at both of those and then lend me money based on that value. They'll also look at other things like credit and your income, your experience, and your ability to pay. But those are not as important for hard money loans as simply the asset. They're mostly lending on the asset. When hard money loans are executed by a lender, they will require you to sign a guarantee that you're going to pay the money back, and they will want usually a budget of what you're going to do and how you're going to fix it. Many hard money lenders will lend you the money to do the repairs to a certain percentage, and that percentage is usually pretty high, sometimes as much as 85, 90, or 100% of the repair costs. And they may lend you 75 to 80 to 85% of the purchase price, depending on the program, the lender, and who they are. Hard money loans charge points or fees. That's the cost of money. So if I was going to buy a bottle of water and it cost me, say, $1 or $2, right? That's what the price of this commodity is. It's $1 or $2. When I'm going to borrow money, it may be a 1, 2, 3, 4 points. A point is 1% of the loan amount. So 1% of $100 is $1. 1% of $1,000 is $10. 1% of $10,000 is $100, right? So as you go up in loan amount, you're going to pay more points. So typically 2% of a $200,000 loan would be $4,000, okay? And that would be your loan fees, plus appraisal, plus other costs. Two types of appraisals that hard money lenders use. Don't forget to subscribe so you can learn all about these things, because a lot of people don't even know this stuff. And I've done lots of hard money loans. I even owned a mortgage company at one point where we lent money. So make sure you subscribe, like, comment so you can get this stuff. Two types of appraisals, okay? One is a desktop appraisal, which is where it's on the computer and they may have somebody drive by and get an idea of the property. Another is a formal appraisal where they'll actually go to the property and somebody will do a write-up and do comparable sales. I just did a video on comparable sales on comps. You can watch that video and learn about those. Private money is available to you usually online. If you Google hard money loans in your city, you'll be able to find lenders who do hard money loans. All of them charge fees. All of them charge interest. What's the interest rate in a hard money loan? Typically somewhere between 5, 6, 7, 8, 9, 10, 11, 12% interest. Most of them somewhere between, I'd say, 7.5 and 11.5. Depends on the deal and the borrower and what they're doing. Hard money loans I've used to build new homes. I've used them to acquire land to build stuff. I've used them to buy property all the time in order to get the money to buy it and the money to fix it. And of course, I would put in my portion as a down payment or equity. Your ability to get hard money loans is dependent upon really the property first, its condition, its potential upside in value, what you intend to do. Secondly, your experience. Have you ever done this before? And sometimes, even if you don't have a lot of experience, they will do the deal, but they may charge you a little more money. Your credit or your background, they may look at that. At some point, they may be required to, just because of federal lending laws and fair and equitable lending rules. And of course, they're going to look at the upside of how they're going to get paid back. You have to have a plan of how they're going to get paid back. They're not going to lend you money on a property if they don't see how they're going to get their money back. The last thing they want to do is take the property back. They don't want the property. They want their money back. So when they lend you the money, they charge you the points, you get the money, they will give you the money to buy it, and then they usually will hold back the money for the repairs. And as you do the repairs, they will release money. So let's say you do a new roof, it costs you 10 grand. They'll release you the money that you have reserved for the roof in your budget when the roof's done. So you pay for the roof, they come out and inspect it. After they inspect it, they tell the lender the roof is done and you get paid. What some people make the mistake of is they think hard money loans are going to give them money up front. No, you got to do the work and then they'll reimburse you. That's how it works. The most common people who use hard money loans are house flippers, real estate developers, apartment building buyers who are acquiring a property to renovate it, and people who build property or want to do additions or other things. Private money and hard money is always on hard assets. They don't do things like some of the traditional lenders do. They do things differently. They don't need a big package of all this information because they're not regulated the same as, say, a Chase or a Wells or a Bank of America or US Bank or any other big institutional lender. Those lenders have a lot of different guidelines they have to follow. Hard money or private money has less guidelines to follow and more flexibility. It is not uncommon for real estate investors, even though they qualify for institutional money that's very inexpensive, to not take it and do private money because it's quicker, it's sometimes more of a sure thing, and you end up getting the property in contract and closing sooner. Speed, especially today in a competitive market, is super important to compete with multiple offers. Sometimes real estate investors will write a contract as cash with the option to go get private money. And by doing that, they may get the contract signed by the seller where they may not have had they had to go through a 45, 90-day process to get a traditional financing. So one of the most important things about hard money loans and why they're so valuable is because they allow people to close quick, to get the money, and to have money to fix up the property and to sell the property and pay off the loan. Many hard money lenders also only charge interest only. So I just did a loan recently that was 6.25% on hard money, interest only. Now, if I got a loan for about 4% principal and interest, it's about the same payment. It's pretty close. But with the private money I was able to put, or hard money, I was able to put less money down. I was able to close quicker, and I didn't have to go through all the different paperwork and documentation that would have been required by a regular institutional lender. And doing that, I now can fix up the property, improve rents, improve revenue, reduce expenses, get good operating statements, and in 6 months go to an institutional lender with all that documentation and get a takeout loan, it's called, to get rid of my private money loan from, say, 6.25 down to, say, 3.25, and save maybe 10, 15, $1,000 a month in interest, depending on the loan size, right? This loan I'm talking about was $6 million. So when you have property and you want to get out of the loan, it's important from the beginning, remember that OPM, other people's money, that the OP, other people, they're gonna want their in back. So make sure you have an exit plan. I started working on the exit plan for this property I recently bought. Within a matter of weeks of closing, I was already working on it, right? Because I want to get the takeout loan done. And that may take, 60, 90 days for an appraisal. So I'm Paul Maguire. Remember, hard money loans are available to you. You can find them on the internet under hard money loans for your area. They all charge fees. Make sure that no matter what you do, you have to realize that you got to pay that money back or you could lose the property. Always use realtors, brokers, attorneys, mortgage brokers. If you're not sure and you have questions, don't sign it until you understand everything, okay? There's clauses in all of those things like personal guarantees and certain performance things you need to do with private money. Make sure you understand what you're obligated to and what you're signing before you sign. You may have to have things done by a certain deadline. You may have to make payments during certain periods. If you miss a payment, you may have what's called default interest, where the interest goes from, say, 7% to 12%, okay? If you don't pay the taxes, they may increase your loan interest rate or your payment. So all those things are going to be in your loan contract or your loan document. So make sure you read them thoroughly and you understand them. And I'll see you on the next video where I'm going to talk about a similar subject. What is seller carry financing? So I'll see you there.